America's economic map is shifting fast, and the Sun Belt is taking over. Here are 3 cities seeing huge population growth, major business expansions, and rising interest from people looking for better jobs, affordability, and quality of life. Fort Myers, Phoenix, and Dallas are each transforming in their own way, from rebuilding and medical growth to tech manufacturing to massive corporate relocations. These places are drawing new residents for a reason. If you're watching the next big demographic and economic trends in the U.S., these are 3 Sunbelt cities you'll want to know about. To really get where we're going, you have to appreciate where we've been. And for what felt like an eternity, the XRP ecosystem was held hostage by one of the biggest legal battles in crypto history. The SEC sued Ripple Labs, claiming that its sales of XRP were an unregistered securities offering. This wasn't just another lawsuit, it was an existential threat that created a toxic cloud of fear, uncertainty, and doubt. Major exchanges delisted XRP, cutting off access for millions of US investors. The price stagnated, badly underperforming during bull markets. While other coins were hitting new all-time highs, XRP was shackled by legal ambiguity. For the holders who stuck around, it was a brutal time. And the main question wasn't when moon, but will XRP even survive? And then the tide turned. After a long fight, Judge Annalisa Torres delivered a landmark ruling that sent shockwaves through the industry. The court made a crucial distinction. While some of Ripple's direct institutional sales in the past were deemed security offerings, the XRP that you and I buy and sell on exchanges, programmatic sales, were not. This was the moment the community was waiting for. It was a declaration that the XRP token itself, as traded by the public, is not a security in the eyes of the court. The final chapter of that saga closed in mid-2025 when both sides agreed to end the legal war. Ripple paid a civil penalty and remains under an injunction for certain direct sales, but the core victory was secured. XRP has regulatory clarity for secondary market trading in the US. This wasn't just a win for Ripple. It was a massive de-risking event for the entire ecosystem. The single greatest barrier to institutional adoption had just been knocked down. Why does this matter so much? Because large conservative institutions, pension funds, insurance companies, major asset managers simply won't invest in assets with a murky legal status. The risk is too high. Before the ruling, buying XRP was a career risk for a fund manager. After the ruling, it became a strategic opportunity. The end of the SEC lawsuit wasn't just the end of a court case, it was the firing of a starting gun. It signaled to the world of traditional finance that XRP was open for business. It was a bright green light telling every major financial institution they could start their research and build their investment cases without the looming threat of a regulatory crackdown. With the legal storm clouds finally parting, a powerful new dynamic began to take shape. For many retail investors, the mindset was still stuck in the past, conditioned to expect the worst. They were watching the old battlefield, but the war had moved to a new front. This new front isn't on social media. It's in the boardrooms of Wall Street. While the crowd has been asking, why isn't XRP moving? The institutional world is asking, how do we get exposure to XRP? The evidence isn't in yesterday's price chart, but in the institutional products being filed for today. The most powerful evidence of this shift is the race to launch Spot XRP exchange-traded funds, or ETFs. An ETF is a game changer. It allows investors to buy shares representing an asset like gold, oil, or XRP through a normal brokerage account. For institutions, it's the holy grail, a regulated, insured, and easy way to invest without the headaches of direct custody. And we've already seen the filings begin. We're not talking about small unknown firms. The titans of finance have signaled their intent. Grayscale, ProShares, Bitwise, and Franklin Templeton are among the 11 major asset managers that have shown interest in offering a Spot XRP ETF. These companies manage trillions of dollars. They don't enter a market unless they see massive, sustainable demand from their clients. Following the approval of a leveraged XRP futures ETF from ProShares, analysts now see the path clearing for a spot product, with some assigning a high probability for approval as early as the end of 2025. We are no longer talking about a fantasy. We are talking about a potential flood of institutional capital waiting for the final green light. This quiet preparation is creating a new dynamic, a potential supply shock. On-chain data shows that XRP reserves on major exchanges are hitting multi-month lows, a sign that tokens are being moved into cold storage by long-term holders. Every share of an XRP ETF that's eventually bought will require the fund manager to go into the open market and buy the real XRP to back it up. This isn't retail FOMO. This is structural, systematic buying pressure in the making. Some analysts project that institutional inflows into these future ETFs could reach $5 billion to $7 billion. Think about it, billions of dollars in mandated buying, all competing for a shrinking pool of available supply. This is the new reality. The players have changed. And if you're still looking at XRP through a pre-2024 lens, you're missing the bigger picture. The real opportunity isn't just about catching a daily pump. It's about understanding this massive underlying shift in ownership from short-term traders to long-term institutional giants. So why are these colossal financial institutions suddenly so focused on XRP? The answer is one simple, powerful word: utility. Unlike thousands of other cryptos, XRP was designed from day one to solve a real multi-trillion-dollar problem: the ancient, slow, and expensive system of cross-border payments. Think about how international payments work now. If a bank in the US wants to send money to a bank in Asia, it's a mess. The money hops between several correspondent banks, each taking a cut, and the whole thing relies on nostro vostro accounts. That's a fancy term for banks having to park huge amounts of cash all over the world, just waiting to facilitate payments. It's a system that ties up trillions in dead capital, takes 3 to 5 business days, and is incredibly inefficient. It's 1970s tech in a 21st century world. This is where Ripple and XRP come in. Ripple's payment network, which serves hundreds of financial partners, offers a modern solution. The crown jewel is its on-demand liquidity, or ODL, which uses XRP as a bridge currency for instant settlement. Here's how it works. Instead of locking up cash, the US bank can use its dollars to buy XRP. That XRP zips across the XRP ledger in 3 to 5 seconds to an exchange in Asia, where it's instantly sold for the local currency and delivered. The whole thing settles in seconds, not days, for a fraction of the cost. It eliminates the need for all that pre-funded capital, potentially freeing up trillions. This isn't just a white paper theory, it's already in use. Major payment providers have used Ripple's technology to power their payment corridors, proving its real-world effectiveness. This is what institutions see. They don't see a meme coin, they see a technology that can re-architect the plumbing of global finance, saving them billions. And the story doesn't stop there. A new powerful narrative is emerging around central bank digital currencies, or CBDCs. Governments worldwide are developing digital versions of their currencies. But how will a digital euro talk to a digital yen? They'll need a neutral, efficient bridge asset to connect them all. Ripple isn't trying to compete with CBDCs. It's positioning XRP as the essential infrastructure between them. The company is already active in this space, working on pilot programs with countries like Palau and Bhutan. Plus, Ripple's deep involvement with ISO 2022, the new global messaging standard for banks, means its technology already speaks the same language as the future of finance. This is the bedrock of the long-term investment case. It's a bet on the inevitable upgrade of the global financial system. As money goes digital, the need for a fast, cheap, and scalable settlement asset will only grow. With its partnerships, regulatory clarity, and proven tech, XRP is arguably a leading candidate for that role. If real-world utility is the bedrock of the XRP investment case, then the launch of Spot XRP ETFs is the rocket fuel poured on top. The two work together in a powerful feedback loop that could drive a structural repricing of the asset. As we said, an ETF is a gateway. It's a regulated bridge connecting the vast ocean of traditional capital to the world of digital assets. Before, for a pension fund to invest in XRP, it was a compliance nightmare. They'd need to set up crypto exchange accounts and navigate complex custody rules. It was just too much friction. A spot ETF blows all that friction away. A fund manager could buy XRP for their clients as easily as they buy shares of Apple, all within a familiar regulated framework. It democratizes access for the biggest pools of money in the world. The Bitcoin ETFs gave us a stunning preview of what happens when this gateway opens, with tens of billions of new capital flowing in. Now, that same mechanism is being prepared for XRP, but there's a key difference. The main story for Bitcoin ETFs was digital gold. The institutional case for XRP is rooted in utility. This adds a powerful layer. Institutions wouldn't just be buying a passive asset they hope goes up. They'd be buying a piece of critical financial infrastructure. The projected $5 to $7 billion in early institutional inflows is just the start. As Ripple's ODL grows and its role in the CBDC world solidifies, the demand for XRP from the financial industry itself will grow right alongside the investment demand from ETFs. This creates two powerful sources of buying pressure. Now let's connect this back to the looming supply shock. The total supply of XRP is finite. 100 billion tokens were created and no more ever will be. A big chunk is held by Ripple or locked in escrow. Whenever an institution eventually buys a share of a Grayscale or Franklin Templeton XRP ETF, the fund manager has to buy and lock away the equivalent amount of real XRP from the circulating supply. Think of it like a sponge. As these massive ETF sponges are placed into the market, they'll start soaking up the available liquidity. The more demand for the ETFs, the more XRP gets pulled off the market and locked away in institutional vaults. This leads to supply scarcity. As the freely traded supply dwindles, even small increases in demand can have a huge impact on price. The days of a vast ocean of XRP being available for cheap may be numbered. This is the core of the long-term thesis. Utility creates the long-term demand story. ETFs provide the regulated gateway for investment. And that institutional buying systematically removes supply from the market, creating the conditions for a supply shock. It's a powerful trifecta of forces, all converging at the same time. With the foundation of regulatory clarity, the catalyst of pending ETFs, and the bedrock of utility in place, we can start to connect the dots. What could the next few years hold for XRP? This isn't a wild guess. It's an extrapolation of the powerful trends we've just broken down. It's crucial to remember that these are not guarantees. Crypto is volatile. However, some analysts have started to model the potential impact of these forces. In the near term, should Spot XRP ETFs get approved and launched successfully by late 2025 or early 2026, the initial supply shock from institutional inflows could be the primary driver. More conservative analyst price targets for this period fall in a range between $3.80 and $5, with some seeing potential spikes toward $10. Looking further out toward the end of the decade, the narrative is expected to broaden. The focus would shift from ETF flows to the accelerating adoption of ODL by global banks and the first real results from CBDC partnerships. As real-world transaction volume on the XRP ledger grows, the utility case becomes undeniable, potentially leading to a significant revaluation based on fundamental demand, not just speculation. What's critical to understand is that this is a long-term investment thesis. It's the exact opposite of the get-rich-quick mindset. The institutional players getting ready to move into XRP aren't doing it for a one-week trade. They are making a 5 to 10-year bet on the tokenization of finance. They know that rebuilding the world's financial infrastructure doesn't happen overnight. This is the opportunity on the table today, the chance to align with the long-term strategic vision of institutional capital, potentially before the full effects of utility adoption and the supply shock are priced in. Now the path forward will be filled with key milestones and updates. Keeping track of the ETF approvals, ODL volume growth, and new partnerships will be key to navigating this opportunity. If you want to stay ahead of the curve with in-depth analysis on this journey, make sure you subscribe to the channel and turn on notifications. We'll be covering every major development as this story unfolds. Of course, no credible analysis is complete without a clear-eyed look at the risks. It would be irresponsible not to. Investing in XRP, like any digital asset, is not a sure thing. First, market volatility is a beast. Broad market downturns can and will affect XRP's price, no matter how strong its fundamentals are. Second, while the U.S. case is resolved, the global regulatory scene is still a patchwork. Unfavorable rules in other countries could slow things down. Third, competition is real. Other projects are also trying to solve cross-border payments. Finally, we have to remember the outcome of the SEC case. While a huge win, Ripple is still enjoined from certain direct institutional sales, which is an ongoing restriction. These are not deal breakers, but they are factors an informed investor must consider. But when you weigh these risks against the sheer scale of the opportunity and the shifts already in motion, a clear picture emerges. The XRP story has transformed. The narrative is no longer about survival. It's now a story of global adoption, real-world utility, and institutional validation. Let's recap. First, the end of the SEC lawsuit gave the legal clarity needed to unlock the floodgates for institutional capital. Second, the race to launch Spot XRP ETFs is creating the regulated gateway for that capital to flow in, setting the stage for a potential supply shock. And third, this is all built on the bedrock of real utility, the power to solve a multi-trillion-dollar problem. The question is no longer if institutions will adopt XRP. The question is how much they will ultimately need as they upgrade their financial infrastructure for the 21st century. We are at a unique inflection point. The fog of the regulatory war has lifted, revealing a clear landscape of opportunity. The quiet preparation by some of the world's smartest money has already begun. For the serious, long-term investor, the thesis is clear, compelling, and unfolding before our eyes. What part of this thesis do you find most compelling? Is it the utility, the ETFs, or its role with CBDCs? Let me know in the comments below.